right. Look, thanks everyone for joining us again today. We're just going to do the monthly economic and market update. And in the throes of doing that, we're just keen to, I suppose, take you through what's happened over the course of the last month, where we're headed, that sort of thing, and as per usual, give you a bit of a summary and an update. You know who we are. There's some cracking photos of us, Andrew.
They're not too bad, are they?
Hey?
Yeah, it's bring out the best of us, I think.
It's amazing what a little bit of
Lighting, specialist lighting.
lighting. Yeah, that's it. Yeah, lighting. That's what it was. All right, let's get into it. All right, so I guess this theme around inflation is still problematic. So we got some inflation numbers in Australia, and they're sitting somewhere around about 6% annualised. As you can see through this chart here, we're looking at a fairly significant increase over the last probably 2 to 3 quarters. Likely, it's expected that we're going to see inflation continue and go higher. Certainly, inflation in advanced economies continues to be problematic as well. So, if we're looking at, say, the euro area there, it's up around about 8.5. The US, probably looking at close to a 7% print. The UK, I know, was looking at 10 at one point. So it's becoming problematic. Even Japan, which hasn't had inflation for a long time, around 2.5%, which is actually quite a good number.
Yeah.
So that continues to be a theme and a problem. This data, of course, is out of date when we get it, pretty much, because we're usually getting the data up to 6 weeks after the event. But as we all know, interest rates have been increasing, and that will likely have an influence on inflation over time. But we'll talk through that in a minute. GDP growth.
Yeah. So look, GDP growth has, I guess, continued to be relatively strong, all things considered.
Yeah.
Again, it's like the inflation impacts associated with interest rate rises. There's that lag effect. So I think it's, even though the rates have been, I think we've had 4 or 5 consecutive months of rate rises here in Australia, and similar in the US. There is that lag effect. So I suppose with all these results, inflation, GDP growth, representing sort of historical data from a few months prior.
Yep.
Yeah, there is that sort of catch-up mechanism. So it'd be interesting to sort of keep a watch on these figures in particular and see how much they change and whether they'll come back. Which you would expect that eventually those rate rises will start to take hold.
Yeah, because of course we'll get to interest rates, but as interest rates rise, it has an impact on both inflation and GDP growth, right? So, I guess the typical example we use, and I might have used this last time, I've been talking about it a bit lately, is the average price to buy a home, and this next slide talks a little bit about that, but the average price of a home in Australia is about $800,000. So if you're a first home buyer, maybe you're lucky enough to be able to save a deposit. Maybe you've got $100,000 as a deposit, so maybe your debt's about $700,000, right? That being the case, debt at $700,000 is going to mean back in December, home loan rates were say 2?
Yeah.
Bit above. Yeah, so let's call it 2, so the math works. 700 by 2 is $14,000 a year in interest. Now, home loan rates sit around about 4, maybe slightly higher. So 700 at 4 is $28,000 a year. So essentially what we're looking at, first home buyers are staring into, is essentially a doubling of the cost for them to be in a home. And that $14,000 over a course of 12 months is now being paid to the bank and can't go out into the economy in the form of renovations or furniture or spending at the coffee shop or whatever it is. And that's essentially how that mechanism of slowing the economy down works. That's what's called monetary policy. So as the economy slows down, if people don't spend as much, and so there's less demand, and we start seeing inflation falling as well.
Yeah.
So just on house prices, again, what we can see here is house prices are currently sitting at around about as far as the ratio is concerned, all-time highs, sitting up around about 6 times disposable income. And correspondingly to that, we're also seeing household debt really rally up there as well. And so we had a little bit of a fall during when COVID occurred, but then sort of took off again as well. So interestingly enough, though, over the course of the last little bit, which we can have a look at in terms of housing loan commitments over here, we're starting to see a bit of a fall in both owner-occupied and investment loans leading into, and this data's to the end of June, leading into the end of June. And so that sort of starts to show that rising interest rates are starting to have an impact, and then that is then reflected through house prices itself. So this one here is the combination of 4 different indices, but again, we've started to see in terms of house price growth, we got up around I remember having discussions with clients at the end of calendar year 21, we saw 20% house price growth in calendar year 21, which is crazy.
That was on the back of, when COVID first hit, there was doom and gloom, and house prices were going to come off 20 or 30%.
Yes.
They did the opposite.
Yeah. The economists got that one right.
Yeah.
We then see that they're starting to fall significantly. So this is a year-on-year number, but we've still seen some growth over the course of the last 12 months, but it's sitting down at about 2 or 3% over the last 12 months. So house prices have come off as well. So again, that thematic continues. Increasing interest rates means it's more expensive to own a home. If it's more expensive to own a home, less people are buying, there's less sellers on the market, so we start to see prices fall, and inflation and GDP growth start to reduce as well. All right, so that's probably fairly familiar for everyone.
Yeah.
Is there any other comments you want to make on that?
Oh, and I think just it'll be interesting, a couple of things around that. I guess we're approaching the peak season, traditional spring season of auctions and selling houses. So I guess we'll get maybe a better read on what's happening with the property prices.
Yeah.
And then as mortgage stress starts to grab hold, a lot of people would have bought into the property market a couple of years ago at fairly low rates around fixed interest rates, sort of sub 2%, and they were listening to the RBA governor making statements that there'd be no rate rise until 2024.
I know.
So I guess it'll be interesting to see how all that starts to play out. Across not only property but also markets and GDP more generally.
Yeah.
Really start to feel the pressure.
Yeah. All right. So look, that's a bit of a quick summary or overview of the economics of what we're facing into at the moment. We might now just walk through a little bit of the volatility in equity markets and that sort of thing. So the chart we've got here is that of the VIX. The VIX measures volatility. This is actually in the S&P 500 VIX. So again, during the last downturn, most recent one, 3 months ago, we saw the VIX rally. So when the VIX goes up, it means that markets are generally falling. And we saw that then start to come off a little bit, and then we had a little bit of a rally towards the end of last month, and then we're starting to see a little bit more volatility again in the last couple of weeks, 3 weeks or so. In terms of world equity, global indices, the performance, we've just run this back for the last 12 months. So Andrew, do you want to talk us through this one?
Yeah, look, I think pretty much everyone would have seen the impacts of this if they've been looking at super balances or investment balances on a regular basis, but particularly over the last 6 to 8 months or so, coming off probably the peak in around about December, early January, where most of the major share markets had peaked, and since that point really started to fall away on the back of a lot of negativity around, there was fears of global recession.
Yep.
Obviously, fears of interest rate rises, which have played out. There's also the Russia-Ukraine war. So there's a lot of headwinds that played out in the markets, and that's and obviously inflation as well. So yeah, we saw a fairly a downward trend for best part of 6 months through to, as these numbers sort of show out.
Which would be this period through here. Yep.
And since about mid June, sort of late June, early July, there's been a little bit of a recovery up until about a week or two ago, and again there's been a little bit more sort of volatility, as you were just referring to in the previous big slides. So there's certainly been some volatility over the short term. And yeah, as we keep saying, it's all about long-term play and just being patient to ride out the
short-term volatility.
Yeah.
Well, I think it's also fair to say that there's always reasons in the world where there's things that are going wrong. 3 or 4 months ago, all we heard every day was the Russian-Ukraine war, and it doesn't seem like that's. And then, obviously COVID as well was created significant issues. Long-term patient capital wins the day in a diversified portfolio. Yeah. And the point of us showing you this really is to see that there is variability in financial markets, which I guess we're all aware of, but it's real and it continues, and it's really important just to be patient, because if I haven't done it, but if I had shown those same numbers for last year, we'd be in a position where essentially we're seeing really significant double-digit returns. So, but everyone focuses more on the downside.
And even within days, there's been some quite wild swings. So some of the markets have been trading positively, say in the morning trade, and then in the afternoon it's completely reversed, and the days ended up in negative territory.
Yeah,
so
that's
there's been some wild swings, obviously not only day to day, but within days as well, as more and more information comes to the market.
Patience is best.
Correct.
We've had similar issues in bond markets. So, and again, we ran through this last time, so I won't spend too much time there. Essentially what you're looking at here is both global bonds, which includes US treasuries, and includes 10-year Aussie government bonds, US government bonds, etc. And we've seen pretty large negative returns for bonds. So this is almost the bear market in bonds as interest rates rose. From that low here, we did see a bit of a rally back up in bonds. So if you want to call that it got down to about a minus 15 year on year. We were actually looking at around about a minus 10. That's sort of fallen off a little bit again lately. So patience in bond markets is the key. And the reality is in bond markets, holding capital to term means that you actually don't participate. This is when you're crystallising your losses, right? So important to understand that. And again, just over the last month or so, we've seen those markets fall off and then rally back up again. However, the global bond index didn't get as much of a rally. All right, so I think that probably takes us through fixed income. In terms of this is just a quick one on the S&P forward PE valuations. PE is typically used as a valuation methodology for working out how expensive equity markets are. And we saw towards the end of 2021, we got PEs on the S&P 500 up to around about 30. So in historical context, that looks expensive. But further context, interest rates were at all-time lows. So you can't just look at that in isolation and say the market was expensive. But we have seen that fall off a little bit over the course of 2022, back into what is a fairly standard range as interest rates increase, or risk-free rate increases. All right.
Just going back over the what's that, sort of close to 20 years worth of data. Yeah, like a normal range is sort of within that 15 to 20 top bracket, isn't it really?
Yeah.
There's obviously some exceptions to that.
That's right.
But that's, to your point, it's back to more of a normal level.
So I think the way we might finish, I might just jump into, I've got the portfolio we use for high growth investors, for some high growth investors here. Not sure if we can still see it or not, but I'll talk through it anyway. Essentially what we've got here is the portfolio that we use for investors that have a very long time frame, so sort of 7-10 years plus, accumulator style portfolios. The idea here is to say, well, let's invest longer term. So let's make sure we've got assets invested in Aussie equities, global equities, maybe a little bit of infrastructure, listed property, global property, which is reflected through here. The 10-year numbers on this sort of a portfolio. So, what we're looking at here is back in 2015 when we had a bit of a fall, very slight fall. This is COVID. We've gone from what would have been worth $25,000 to $20,000. So we saw a reduction there. But again, we've seen recoveries in this portfolio, which is listed equities, right? In this portfolio since that period of time. So the reason I show you this is it actually shows the long-term hold approach, buy and hold approach works, right? As long as the portfolio is diversified. And maybe the other thing to call out is what we're actually invested in from an underlying perspective, because as you all know, we use ETFs in our portfolios. So the largest holding in our portfolios at the moment, on a weighting sense, is BHP, and 3.7% of this 3.7% of this portfolio is invested in BHP. Obviously, Combag, CSL, all these companies we've heard of, right? So Apple, Microsoft, NAB, Westpac, ANZ. So I think it's important to keep that in context, because we do talk about short-term volatility a bit, but it is important to understand that long-term is key.
And again, if you just sort of drop back to that chart, where sometimes the propensity could be for investors to panic a bit, and if you look at those periods where there has been a fall off, people might have the tendency to cash out and back the gains that they've made, and by doing that, invariably markets ultimately do recover, and you miss out on that recovery. So we have spoken previously about trying to time the market, and that can tend to be value destroying, whereas playing the long game and just sort of being to be patient, riding it out, and often, as part of that, it's all about making sure that this is money or capital that you don't need access to in a period of time where there might be volatility.
Yep, exactly. All right, does that wrap us up?
I think so, Ken. Yeah.
All right,
Short
I'm good.
Brief.
Probably 20 minutes or so.
Yeah.
Thanks very much, everyone. Great to have you here and listening again. Any questions, of course, just send them through, and otherwise we'll catch you in a couple of weeks.
Thanks, everyone.
See ya.